All right, welcome everyone to this webinar today. Of course, we're going to be talking about the macroeconomy and also touching upon a number of cross-commodity topics. Again, thanks for joining. My name is Reid Ianson. I cover the macroeconomy here at Kepler and also do analysis across a number of key commodities. I'm joined by my colleague Florian, who is a cross-commodity expert and also our principal analyst looking at renewables markets. Again, today, like I mentioned, we'll be looking at macroeconomic trends as well as a number of key commodities, including crude oil, natural gas. We'll also be looking at iron ore and copper, cutting through to grains, and also be looking at power as well. For those of you who have questions, please go ahead and send those through as the presentation moves along. We'll have a 10-minute Q&A at the end of the presentation, and we have a number of folks from our team who are ready to answer your questions. So again, send those through as we're moving through, and we will absolutely answer them at the end of this presentation. All right, so with that being said, we're covering a lot of topics today, so let's go ahead and start to push through. As I mentioned, we're going to look at the macroeconomic side of the picture first. Just looking at global growth, our expectation is that growth this year will come in at just under 2.5%. This is a bit of a tick down from 2.55% growth last year. We forecast that India will lead the group of large economies, growing at 7% this year. We think China will hit its growth target of 5%. I'll talk about how they're going to do that in the next couple of slides. We see Africa growing in a range between 3 and 4%. United States likely on trend at 2%, and Europe will be the laggard growing at 1%, albeit that is a bit of a tick up from 0.5% last year. Just looking at the United States first, again, our central narrative is that the U.S. economy continues to remain relatively resilient. We see growth this year at 2%. However, this is a 50 basis point slowdown in growth relative to last year. So again, that's some of the reason why you're seeing an easing in some macroeconomic data. It's just off a very high 2023 baseline. However, it is important to note we might need to revise down our 2% number if Q2 comes in a little bit weaker than expected. Atlanta Fed GDP Now figures are currently indicating growth of around 1.8%. If we come in around that level, we might need to revise lower our 2% expectation. But for now, we're going to stick with our forecast of 2%. The U.S. economy has been the key driver of growth over the last 18 months, and this is largely driven by a relatively healthy labor market. And while we have seen a bit of easing in the U.S. labor market over the last several months, right? Unemployment now is at 4.1%. We were in the mid threes, say this time last year. So the unemployment rate has loosened a bit. We still think that the demand for labor is outstripping supply by about 1.5 million workers. So we still think that the U.S. economy is relatively tight, despite the fact that we have seen some easing this year. And also important to note, a lot of this being driven by the fact that there's been a lot of legal and illegal immigration into the United States that's helping to provide supply into the labor market. Our core theme around inflation and our core forecast has been that inflation is going to remain sticky around the 3% level on core CPI. So it's largely driven by, again, our expectation that the U.S. economy is continuing and will continue to remain relatively resilient. However, with that being said, many of us have seen the June CPI figures that came out this morning. They were under expectation again. The last 3 months, we've kind of seen a reintroduction of the disinflationary trend that we saw through the second half of last year. And so I'm going to hedge myself a little bit here and say that the possibility of a Fed rate cut in September is rising. We'd say maybe just in one single adjustment cut this year. However, for now, our base case, given our assumption that we think inflation is going to remain around 3%, is that the Fed's not going to cut this year. But we fully admit that the chances of a cut in September have risen a little bit. But again, with that being said, we see inflation kind of holding around the 3% level unless we get a significant weakening in the labor market. There's not a lot of evidence of that right now. Yes, we've seen a slow tick higher on unemployment, but we don't see unemployment pushing to 4.5, 4.6%, which is probably what you would need for inflation to sustainably return to 2%. And that would imply a recession. Again, we are not in that camp right now. Part of this, again, US running very high deficits as well. That's also inflationary. So just keep an eye on how much money the government's spending. And right now they're spending a lot. Their deficit spending a lot. That is helping to prop up inflation as well. Moving on to the European Union next, we see growth this year at 1%. This is a tick up from half a percentage point growth last year. However, with that being said, we've become a little bit more concerned about European sticky inflation this year. Inflation has started to look like it's kind of getting stuck above the ECB's 2% target. Obviously, we saw the ECB cut rates in June. Our initial expectation was that the ECB would cut every other meeting. So that would assume in September, they'd cut by another 25 basis points. And again, at the end of the year. However, we kind of want to introduce some caution here. If inflation continues to show, it continues to be kind of sticky over the next couple of months, we think the chances that the ECB maybe pauses is rising here. So just keep that in mind. Market consensus is that they're going to cut in September, but just keep an eye on inflation. We think, again, if it remains kind of elevated over the next couple of months, ECB might decide to pause and not cut until the end of the year. More broadly speaking, the uptick in growth that we're expecting this year is going to be driven by, and we're already seeing evidence of this through the first half of the year, being driven by improvements in household consumption across the European economy, again, driven by a tight labor market, low unemployment. Consumer sentiment continues to trend towards new post-Ukraine highs as well. Investment will lag because monetary policy remains pretty tight. So it's really going to be that area of strength in the European economy is going to come from the consumer. Shifting to China next, as I promised, I'd provide some comments on how China would meet their 5% growth target, which they announced in early March. It's our view that we would see, coming into this year, we would see an intensification of fiscal stimulus. Obviously, we got an extraordinary bond issuance in October of last year and the approval of another special bond issuance in early March alongside that growth target announcement. We also expected and have seen this come to fruition that Chinese stimulus would largely emphasize investment, largely emphasize specifically within investment, manufacturing build out, and China would effectively rely on exports to drive growth. And that is certainly what we've seen up until this point. Industrial production growth is well above the 4.5% growth level we saw last year. We've also seen manufacturing fixed investment growth tick up to 13% this year, up from 8% at this point last year. So again, China certainly flowing funds into manufacturing. However, this does not include the consumer. China not providing much support to the household consumer. We think spending growth is, it grew at 7% last year, going to be well under that, probably 3 or 4% this year. There are concerns around how much longer China can continue to rely on this kind of growth model. We've seen China really start to ramp exports again, especially across EVs, batteries, solar panels. There's a lot of pushback now from economies around the world, from Europe to the United States. Places like Brazil are importing steel import tariffs, EV import tariffs, because of concerns about decimation of domestic industries because of cheap Chinese good imports. And so we want to add a note of caution here. We think China's going to hit their growth target because of a reliance on exports. But the uncertainty is growing around how countries around the world might respond to what's going on in China right now. And I think the trend is towards higher tariff barriers. And more broadly, it's important to keep in mind that China needs to find a way to shift away from their investment-led growth model towards a consumption-led growth model. But we're not really seeing evidence of that right now. And evidence would be fiscal transfers to households, higher government benefits, things of that nature. And we're just not seeing that right now. And that's really what China needs to do for over the longer run to ensure a more sustainable growth model. So important to keep in mind, we're talking about the short run here. They're going to hit their 5% target, all of that. But important to keep in mind that over the longer run, China faces a very tough road ahead as they, come to grips with the likelihood of shifting from investment to consumption. Lastly, let's just touch on India, and then I'm going to shift to talking about commodities next. India is going to be the growth leader this year. We see output expanding 7% year over year. Q1 quite strong. We saw growth at 7.8%. How, however, test, 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 test. Sorry about that, guys. I lost my mic there. All right, just to finish out on India here again, as I mentioned, we expect growth at 7% across India. Strong Q1. However, with this relatively elevated growth level, uh, inflation has shown signs of being quite sticky. Recently, headline inflation is holding at 4.8%. This is well above the RBI's 4% target. And so we think that if the RBI uh, does decide to cut this year, um, they will uh, they will not do so until late this year at the earliest. Just one other point here. In early June, obviously, we saw the BJP, considerably underperform expectations when it came to elections. And so, as I've listed here, just a number of potential outcomes. We think possibility for higher welfare spending as the BJP tries to induce, commitments across some of the parties that they're aligned with. We also think there's the possibility for a slowdown in infrastructure build out and scrutiny over manufacturing subsidies. So again, I think Indian investment growth will continue to be quite strong this year, albeit I think the election uh, might limit that growth just a little bit. However, keep in mind, I think that the Indian household consumer this year will consistently outperform against year earlier levels. So that will be a bit of an offset. So again, I think the Indian economy this year looks quite strong. All right, guys. And again, apologies with the tech issues on my end. I think the mic situation has been fixed. So with that being said, we'll go ahead and we'll move on to the crude market. First, let's take a look at our price forecast. If you look at this chart on the right, we think North Sea Dated's going to average just over 87 per barrel through July, and then slowly slide lower through the end of the year, trading at just above $83 per barrel by December. And again, we generally see a downward trend into next year. However, say through late Q2 and into early Q3, which is your typical deficit period for crude balances, we think prices will kind of normalize at around 80, and then begin the slide lower again by the end of next year. We think prices are going to finish out below 78 per barrel. Again, if you look at just the full year averages, we see prices averaging 80 per barrel through 2025, which is a considerable tick lower from the just under 85 per barrel. We see 80 per barrel this next year, down from 85, just under 85 per barrel this year. The big call in the uptick in prices that we predicted really came from the fact that if you look at this chart on the right here, our net long positioning on Brent really bottomed out at very low levels. And we made an argument that you'd need to see some resurgence in net long positioning. That's really what we got. Build in the fact that Q3 is typically, again, as I mentioned, the period where crude crude balances are at a large net deficit. And so, again, we saw and argued for a support in prices coming into this period of the year. However, as I mentioned, we are generally bearish as we move into 2025. Reason being, if you look at our chart on the left here, these are our oil supply demand balances on a quarterly basis. This is just supply less demand. This year, we see demand outpacing supply by about 600 KBD on average. However, that is going to flip to positive next year. We see crude balances running at a net surplus of just over 350 KBD in 2025. And again, you can kind of see the consistent deficits we've seen over the in the post-COVID period have really drawn down inventories, but this could very well reverse into next year as we do see net balances lengthening quite a bit again. Why do we think this? If you look at the chart on the right, it's really a supply story. We see supply, we see oil production expanding by 2.2 million barrels per day, largely driven by OPEC. Again, if you look at this bottom part of this chart here, most of the year-over-year growth is going to be coming from OPEC by the end of next year. And demand, which is this chart on the left, just cannot keep up. We think demand next year is going to be up around 1.3 million barrels per day. And again, this largely explains why we see a lengthening in the crude balance next year. OPEC is going to open the taps and push a lot more volume onto the market. All right, with that being said, let's shift to natural gas and LNG next. I'm going to basically break this into regions. I'm going to look at the United States first, then I'm going to shift to Europe and finish out with Asia, and then I'll hand it off to Florian to cover a number of other commodities next. So first, let's look at the United States. If you look at this chart on the left, again, this is your net long positioning, which is this black line. You'll notice we've seen a recovery in net longs since the winter period. A lot of this has been driven by the fact that supply, which is this upper chart on the right, has significantly declined in recent months and will remain lower year over year until March of next year, based on our forecasts. So again, this has been quite supportive of Henry Hub prices. This has been supportive of bullish positioning as well. And if you look at our forecast for Henry Hub over the next several months, we are bullish. We see prices topping out at $3.70 per MMBTU by the end of the year. Again, this is driven by several factors, including, as I mentioned, declines in domestic production year over year, but also a relatively strong demand season through the summer. And then even into next year, we see Henry Hub finding a floor above $3 per MMBTU as additional LNG capacity effectively works to cause some degree of convergence between Henry Hub and your large import benchmarks of JKM and TTF. And interestingly enough, as I mentioned, it's interesting to watch how rising U.S. LNG capacity is slowly but surely going to cause convergence between Henry Hub and JKM and TTF. And that kind of flows through to our expectation around European prices as well, which I'll touch upon in a minute. But just note here, we have seen in recent months TTF has ticked up a little bit, mostly due to a decline in LNG imports and some unplanned outages in Norway. However, the market is not so worried as to bid up the price enough to really pull significant volumes from Asia, right? We're not seeing TTF trade at a premium to JKM, right? And generally speaking, you'll notice, like especially through the winter period, we see prices broadly lower year over year. And again, this kind of points to the fact that, as I mentioned before, additional U.S. LNG capacity, especially into next year, is going to help to weigh on TTF just as it pulls up Henry Hub a little bit, right? You have this convergence dynamic at play. But broadly speaking, I think the market's not too concerned about the supply situation in Europe. Otherwise, you would see TTF trying to price in a way to pull more volume into the region. The situation is quite different in Asia, right? If you look at the chart on the left, LNG imports broadly higher year over year. Again, this is opposite from Europe. Again, if you look at the chart for Europe, broadly lower year over year. For Asia, they're broadly higher year over year. Again, a lot of this is being driven by pretty strong demand conditions. Places like India are quite hot at the moment, and that is helping to pull volume. Again, JKM is consistently trading at a premium to TTF. However, similar to the dynamic in Europe, we don't see prices this winter, or excuse me, we see prices this winter consistently remaining below year earlier levels. However, because of the demand situation in Asia, which we think is going to remain quite strong, JKM is very likely going to continue to trade at a premium to TTF. But the same kind of structural factors we see in Europe are kind of in play in Asia in terms of the additional LNG export capacity coming online in places like the United States will help to put a limit on the upward increase in JKM spot prices. Again, we're seeing that convergence dynamic take effect between Henry Hub and JKM TTF. So with that being said, I'm going to hand it off to Florian. He's going to take a look at iron ore, copper, going to have some commentary on power and grains as well. So Florian, I hand it off to you, my friend.
Thank you, Reed. Hello. As Reed introduced, we're going to start and continue with iron ore. Next slide, please. There's been strong volatility in iron ore markets over the past year. Prices peaked at $144 per ton in January. And after a plunge half of the year, iron ore currently stands at around $110 per ton. Our main message regarding iron ore is in the second half of the year, we see further downside to prices. Next slide, please. Read, please, to the next slide. Thank you. So I said our main message for iron ore is we see further downside to iron ore prices. Where does this come from? The global steel sector remains weak. On the left-hand side, you can see prices of iron ore, of the major steel products, and also of metallurgical coal indexed to January 2023. And you can see that despite the plunge in iron ore prices this year, iron ore continues to outperform the wider steel sector, meaning there's still room for further iron ore price corrections lower. Zooming into China, latest Chinese steel production figures for May came in strong, but in our view, this does not signal a rebound in Chinese demand, mainly for two reasons. This was a seasonal peak, and also high Chinese steel production was not absorbed domestically, but it led to a surge in Chinese steel product exports. You can see that on the chart on the right-hand side. Steel product exports rose to an 8-year high and are up 23% year on year. We do not expect that this high level of steel exports can be sustained. As Reed mentioned earlier, other countries such as South Korea, Brazil, but also the EU are set to implement tariffs. And this is something that has already happened in 2016. You can see back then also steel exports from China surged, and the reaction was higher tariffs in the major consuming regions. So lower steel exports from China will subsequently also weigh on Chinese iron ore imports. So far, iron ore imports have outpaced steel production this year, and this, of course, resulted in a rise in iron ore inventories. At Chinese ports alone, we see a rise of 24% year on year. The next slide, please. The chart on the left illustrates that the discrepancy between Chinese steel output and the domestic steel demand has been in place for long already. You can see Chinese housing starts have plummeted, but steel production has remained very strong over the past 2 years. On the right-hand side, you see that iron ore availability in China keeps growing. So steel production outpaced domestic steel demand, and iron ore availability even outpaced demand from the steel sector. So our main message here is that that the strong discrepancy between Chinese steel demand and current iron ore imports will continue going forward. Touching briefly on supply, iron ore supply is remained firm this year. Brazilian exports had a strong start to the year. Australian iron ore supply moved towards a seasonal peak in June, which marks the end of the fiscal year for BHP and other miners. And also the smaller ore producers, such as Canada, are currently moving towards a seasonal peak in export. To conclude, our main message, iron ore prices, there's further downside potential in the second half of this year because of steel sector weakness, high iron ore stocks in China, and firm supplies globally. Next slide, please. We're now moving from iron ore to copper. Our main message here, we also see downside potential to prices in the second half of the year, but we do expect a rebound next year. Why do we think there's a downside? Mainly because of a strongly oversupplied Chinese market. Bear in mind that China accounts for more than 55% of global copper demand. And also other bearish factors have emerged. For example, Indonesia postponed its copper ore export ban from June to January next year. And also the startup of phase 3 of the Kamoa-Kakula mine in the Democratic Republic of Congo was much earlier than anticipated. Overall, we do see a price floor for copper of around $9,300 per ton in the second half of the year. Next slide, please. Now, zooming in on China. So why is there no tightness in the Chinese copper market, which somehow counters the current bullish copper narrative? First of all, domestic Chinese copper production remains very high. Why is this important? Because in March, Chinese smelters announced to cut runs this year, and this was one of the main triggers of the copper price rally. Bear in mind that all the bullish long-term copper fundamentals, all the energy transition applications, they have been in place already for much longer and not only emerged this year. So despite this announcement to cut smelter runs, there are many indications that Chinese copper production remained very high. Treatment charges are exceptionally weak, the smelters margin, so to say. Copper import spot premiums into China, they turned negative in May and June. It's an extremely rare occurrence, and it also points to very weak Chinese buying of refined copper from abroad. And last but not least, Kepler flows data shows that copper concentrate imports into China have trended at very high levels year to date. You can see this on the next slide. You see copper concentrate imports, they follow a seasonal trend, but overall, with the exception of May, they have been very, very high this year. So on the one hand, in China, we have high domestic copper production. At the same time, we have weak domestic demand. Of course, the weakness predominantly comes from the construction sector. Land sales and housing starts remain highly subdued. And as Reid already mentioned, Beijing's fiscal stimulus is targeting the manufacturing segment more strongly than the more copper-intensive construction sector. Still, it's also worth mentioning that the massive renewables expansion in China somehow dampens the effect on copper demand from weak construction. So we have high availability of copper in China, we have weak domestic demand, and also we have weakening export demand ahead, because the US tariffs that were introduced include a lot of copper-intensive goods, such as EVs, solar cells, and batteries. All of these factors will lead to a counter-seasonal rise in Chinese copper stocks, and potentially in future, we see structurally higher stocks in China now that copper turned into such a hot commodity. Next slide, please. Touching upon a copper supply topic, As mentioned, Indonesia introduces a ban on copper ore and copper concentrate export starting in January. And what will be the impact from that on global flows? India has been the largest offtake of Indonesian volumes, and it will likely have to resort to traded South American volumes next year, mainly because India has very little equity investments abroad in mines, meaning they will have to resort to new capacity, new copper available in South America. In Japan and South Korea, they're in a more comfortable position because Japanese companies have vast equity stakes, predominantly in Chile and Peru, and that's also where we think that's where this will substitute Indonesian volumes from. China, we expect next year that Africa to China copper concentrate flows will rise further. Again, mainly because that's the region where Chinese equity investments are focused. So to summarize, next year, no Indonesian export of copper concentrate, but great.
All right, guys. It looks like my colleague PC has crashed. We have all the tech issues going on today. I apologize. We're coming to you from Houston, and things are a bit of a mess at the moment with power surges and issues with power availability. But we are trying our best to push through here, guys. So again, apologies for the tech issues. However, I'll go ahead and push forward, wait for Florian to try and rejoin. Let's push through to the power side now. If you look for this first chart here, just looking at supply and demand, we're going to focus on the EU here, just looking at supply and demand dynamics across the EU 27 power market this year. If you look at the chart on the left, power production levels, renewable levels look very strong, despite the fact that the overall EU 27 power load looks to be trending towards the low end of the 5-year range. However, this is an important dynamic because it tends to weigh on the need for LNG, natural gas, and coal. And this kind of flows through to what I was saying earlier in the presentation on the nat gas side of things. You know, folks are not super concerned when it comes to European supply dynamics because demand doesn't look that strong. And part of that is a power story, of course. And again, if you just look at total renewable output, again, running well beyond the 5-year range at this point. So again, we think that this dynamic could continue. And if you look at prices, again, this renewable story has really been playing a role in driving the number of negative power price hours over the past 5 years, even just over the last couple of years. Your number of negative power price hours have been towards the very top end of the historical range. And if you look at prices here, this is just power spot prices and future expected prices as indicated by the market, which is this obviously this orange dotted line. We actually think that prices will come in under this expectation, and we think that a continuation of a relatively high number of days where number of days of negative power prices are absolutely on the table at this point. So again, just thinking about the European power market, outright load looks pretty weak right now, and load is being increasingly supplemented through very high renewables production as well. Florian, are you back, my friend?
Yes, I am back.
All right. Apologies for that again, guys. I'm going to hand off to him. He's going to finish off with grains, and then we'll do a quick Q&A.
Yeah, sorry about that. Of course, these technical glitches always happen during the webinar. So let's continue with corn and soybeans. Our main message, next slide, please. Our main message is that prices for corn and soybeans should remain weak, whereas wheat prices are prone for spikes later this year. Overall, the market has been weather-led for the last few months, and this will continue in the next 2 months because of the growing season in the US, especially for corn and soybeans. And on the demand side, it's first and foremost China's buying patterns that need to be monitored. Our first topic is the wheat-corn spread. On the left-hand side, you see wheat supplies lower year on year. This is mainly because of dry weather in Russia. Russian supply is expected to come in 10% lower year on year. They had issues throughout the growing season. And Kepler's trade expectations for wheat are only 170 million tons in the 24-25 season compared to more than 180 million tons this year. Regarding corn, supplies are also lower year on year, but they're rather back to normal levels seen in previous years. On the right-hand side, you see the wheat-corn spread. It trended higher this year in accordance with the above-mentioned supply fundamentals, and it will be the purpose of the market to maintain a wide spread so that no wheat goes into animal feeding. That's something that's frequently done in Europe, but also in Southeast Asia, if wheat prices are just above corn prices. So our base case is that we see a wide spread for the rest of the year. However, if this cannot be maintained, then we will see a start to wheat feeding, and this will very likely lead to a spike in wheat prices later on. Next slide, please. The US-China trade. Brazil became the largest exporter of corn last year. It overtook the US. And also China has since last year shown a clear preference for Brazilian corn over US corn. You can see that on the left-hand side of the chart, how Brazilian exports have rapidly replaced US exports to China. Price played a role, but also geopolitics, of course. We expect this shift to continue this year, with China taking very little US corn. On the right-hand side, you see yearly US soybean exports and also US ending stocks. We expect to see a similar trend like in corn in soybeans, meaning less Chinese buying of US supplies. Overall, with US exports potentially down and paired with a solid US soybean harvest this year, we expect that the US will end up with very high ending stocks. This could be a similar situation as we saw in 18-19, where also a drop in exports led to a strong increase in stocks, which could lead to a price collapse in the domestic prices in the US, especially for soybeans. Next slide, please. So China increasingly shunning US corn and soybeans is also reflected in seaboard futures, where the speculative market positioning remains extremely weak across both segments. Again, our main message, that China's shift towards Brazilian corn and soybeans away from US volumes, coupled with solid US soybean supply this year, will put a lot of pressure on domestic US prices in the second half of the year. So thank you so much for your attendance. We're now open for the Q&A.
Thanks for that, Florian. Again, apologies for all of the technical issues today, but we're going to go ahead and take some Q&A. First question coming through, I think I'll direct this to the crew team. So maybe Victor or Hamayoun, if you want to jump in on this. What are the chances that OPEC does not open up supply next year? Do you think there's a chance of that, or is it pretty much set in stone that they will open the taps next year?
I can take it. Can you hear me okay? Can everyone hear me?
All good, Hamayoun.
Yeah. So yeah, I think it's likely that at least the taps don't get opened this year at the end of. So initially, the plan is to start bringing those barrels back gradually from the beginning of Q4. So they have an upcoming meeting taking place in September, and it is possible that based on what's happening, basically based on what prices are at that time, that they delay that decision. So last time, in beginning of June, the market took that OPEC announcement as if supply was certainly going to come back from Q4, but OPEC maintains that flexibility in its decision. So depending on what's going to happen, it could be that supply only starts to come back next year. Now, I think the other point to watch in terms of how fast that calendar could advance next year is the state of obviously global oil demand, but also the state of the competition. How much growth, how much crude supply growth you still have in the US and in other countries such as in Guyana. But we are confident that OPEC is probably going to start bringing those barrels back from the beginning of next year rather than from the beginning of Q4 this year.
Awesome. Thanks for that, Hamayoun. Appreciate that. Next question, we're getting in some questions around just gas pricing. So Ronald, I'll hand this one to you. Just getting a question. Does your TTF gas price forecast assume a colder winter than in 2022 and 2023? By how much could TTF gas prices go up if we have a colder than average winter?
Yeah, hi, thank you. So yeah, basically in our forecast, we assume like a colder winter compared to the numbers that we had in 2022 and 2023. So we are taking the 10-year average for our forecast. So basically, in terms of like what this could mean for prices, well, it really depends like how demand like overall like will play out there. But like we don't think that demand could actually increase significantly, even in the case of like having a cold winter. So like for prices, we will see like a potential for upside, but like not going into uncharted territory, definitely.
Awesome. Thanks for that, Ronald. Now we're getting some questions on copper, which has definitely been in vogue this year. So maybe Florian, we'll go to you on this one. Obviously, much of the conversation around copper is, how far our price is going to go up over the long run. But do you see some, downside risks to copper prices over the long run?
Well, let's start with the supply side. We do not see downside risks to prices from the supply side. The greenfield mining pipeline is very limited. There are various startups that claim that with the use of AI, they can improve the exploration of copper. And this might be true. But however, these companies will also not be able to circumvent this average mining lead times of around 13 years. On the demand side, there are some talks that aluminium could play an increasing role for certain applications because aluminium boasts a higher conductivity on the weight basis, not on the mass basis, but on the weight basis, higher than copper. So there are some applications, for example, long distance, high voltage lines where aluminium is increasingly being used. There are some efficiency gains from EVs where they try to reduce the copper content, mainly via higher voltage systems. But overall, we're not talking about any significant downside risks. So in our view, the discrepancy between supply and demand in copper will further increase the longer we look forward.
All right. I appreciate that, Florian. Now we're getting some questions in around grains. So I'll hand this off to you, Ishan. Latest question is, latest China feed grain policy focuses on self-sufficiency. How much will this factor into global corn demand in both 23-24 and the 24-25 seasons? All righty, Sean's not coming through. Dimitri, we'll get back to you on that question for sure. Another question maybe for Alexis, being asked about just the overcapacity in China, especially on the iron ore side of the equation. Obviously this year we've seen pretty elevated smelting activity again, despite the fact that the property market remains in deep contraction. Do you have an expectation for, maybe some deeper smelting, cuts for steel production second half of this year? Or do you think that smelters will remain at pretty elevated capacity levels?
Hi, Reed. You hear me okay?
Yep, all good.
Great. Yeah, I mean, I think we've seen some preliminary numbers for June already that suggest that there was a year-on-year fall in Chinese crude steel output last month. I mean, this was expected. There is normally a seasonal slowdown at this time of the year, going through to sort of towards the end of the third quarter. So yes, we do expect steel production to slow further. It has been our position for a long time now that Chinese annual crude steel output in 2024 will be lower year on year. There are also suggestions the government's going to enact more kind of controls on production, weighing on as well. You mentioned, earlier in the presentation of Florian's talking about the steel exports. We don't expect those high levels to be maintained in the long term. So overall, bearish on Chinese crude steel production. That will then have a knock-on effect on iron ore. I think you will find that the Australian and Brazilian material is fairly resilient. It's good quality iron ore. It's the cheapest producers, but you'll definitely see a squeeze on some of the domestic producers in China, and also some of the lower grade, more higher cost material. We've already seen iron ore exports from India to China fall sharply. So yes, overall, we do expect that trade to struggle certainly to achieve much growth when it comes to the iron ore this year.
Awesome. Thanks for that, Alexis. And also just one other point on that, it is notable to watch places like Brazil come in very aggressively now and import heavy steel import tariffs on Chinese volumes. So there is a question, could they face more difficulty in selling all this excess steel into the market as well? Ronald, let's go back to you. We've got another question around nat gas. Do you see EU gas storage is filling this summer? If so, when? And at what level do you see end of March levels for next year in your normal weather scenario?
Yeah, definitely. Thanks for the question. So yeah, we see that Europe is in a very comfortable position to reach full levels of storage before the beginning of the summer. So we estimate that by the end of August we will be hitting like 90% of storage. I think yesterday we hit like the 80% mark, and yeah, we'll have no issues in getting up to like 100% levels before November. So in terms of how these storage levels will end up, like for us, like at the end of March we see these levels going down up to like 54%, and this is basically because we estimate that some demand could potentially come back next year, especially if we're thinking of having I guess like a colder winter, and also the fact that industrial demand in Europe could slowly but gradually come back as macro conditions ease gradually.
Awesome. Thanks for that, Ronald. Ishan, I'm going to go back to you, and then I'm going to come to where it looks like we have a question on Russian oil. I'll come back to that one. First, Ishan, I'll come to you talking on Chinese grain sufficiency and how that might factor into global corn demand over the next couple of seasons.
Thanks, Reed. Sorry about earlier. Yes, China does focus on self-sufficiency, but in the recent past, it has not been able to meet self-sufficiency with domestic production, because there is competition between crops in China as well, between corn and soybeans for the same acreage. So at between 15 and 20 million tons of imported corn make up for less than 10% of Chinese corn demand. That is very close to sufficiency. We expect 23-24 demand to be lower than last year, mainly because of lower imports from Brazil towards the end of the year. And we see a similar level in 24-25 as well, between 15 and 20 million tons of total corn demand from China. This is much lower than the 22 to 30 million tons that China used to take from 2020 till 2022. The assumption behind that is that the growth in consumption will not be as phenomenal as seen in the years during the recovery from COVID. So to put it simply, despite an aim towards self-sufficiency, China will be up there as a major corn importer, not importing as much as it did in the past, but still up there amongst the top 5 importers.
Awesome. Thanks for that, Ishan. All right, we're getting some oil questions coming through now. Again, I said I would come to this question on Russia. So maybe Humayun will come back to you. Just could you elaborate a bit on the impact sanctions have on Russian oil, if any? And are there any new trends around Russian flows in general?
Can you hear me fine? Hello?
We can hear you, man. Go for it.
Yeah, okay, sorry for that. Yeah, so I'm not sure what's the exact angle from this question, but of course, I mean, there's been huge changes in the trends. So what's important to notice is that these are sanctions imposed on Russia, including from the US, are not secondary sanctions. So the impacts are not, I would say, as harsh as they could have been, such as the sanctions that have been imposed on Iran. So Russian oil production has remained relatively stable, despite a drop at the beginning of the war against Ukraine. But now, since then, it's been very stable. There's been a drop in the volumes of oil piped to Europe by the Druzhba pipeline. And so, as a conclusion, we've had an increase in Russian oil exports shipped via tankers. And obviously, the big thing to notice is that 90% of that crude is now directed to Asian markets, and the remaining staying in Europe is going to Turkey. So there's still some volumes going to the European Union, but this is only about 300,000 barrels per day via the Druzhba pipeline. So huge trends in terms of a lot of more volumes of medium sour crude heading to Asian markets rather than going into Europe.
Awesome. And actually, Humayun, let's just follow up on that one. Thanks for answering that question with one more on the oil market. What is your assessment of the risk of increased unexpected oil supplies from Iran, Kurdistan, or elsewhere?
Yeah, so I mean, there's a lot of questions on Iran now that a new president has been elected. The new president is more on the moderate side, so he would be willing to open up the channel of discussion and negotiations again with the U.S., but obviously with the elections in the U.S. at the end of the year, nothing's really going to happen before. And even after that, if Donald Trump is elected, the chances of negotiations reaching to a breakthrough are very slim. So Iranian exports right now, they have averaged around 1.5 million barrels per day since the beginning of the year. They're at the highest level since late 2018. But for them to increase more, you need a breakthrough in negotiations. You need some sanctions to be lifted. So unless this happens, we don't think that there's much upside from there. When it comes to Kurdistan, production is actually almost back to levels before exports have been halted, but exports are still halted. So all of that production is consumed domestically in Iraq, and that explains some of the headaches that this federal government in Iraq has in keeping its production in line with the OPEC quota. But we also don't think that the opening of exports could happen anytime soon, probably not before the beginning of or half mid-year 2025. So we shouldn't expect much impact from that on European markets in terms of Kurdish crude.
Awesome. Thanks for that, Humayun. We're going to do one more question to close it out, just asking the power team. I'm getting a question around just expectations for renewables renewables generation, say over the next 5 years, what's the trend? Do you see this, outperformance continuing? And I'll hand this off to Alessandro if you want to answer this one.
Yes, thanks for the question. So, as you have seen in one of the graphs shown by Alex and Florian, renewable capacity has been increasing a lot. In the European landscapes, we had a lot of incentives so far. We have seen in the Netherlands, Belgium right now is stepping up, and we've seen also the landscape in Spain with a lot of solar increasing right now. So, pushing for the Green Deal, I think that if we want to achieve all the ambitions of the European Union, renewables is going to continue to increase, and I think it's gonna be way more increasing than usual now.
All right, awesome. Thanks for that. With that being said, we'll close out this presentation. Thanks everyone for joining. We're going to look to do this on a quarterly basis, just cover a bunch of commodities while also providing a macro outlook. So be looking in your inbox or on LinkedIn or elsewhere for marketing on further webinars that are cross commodity focused. Again, thanks everyone for joining, and we'll see you again soon. Bye-bye.